Before we get into this week's webinar, I just want to give you one more reminder. We are closing memberships for New Era Fortunes on Friday. That's your last opportunity to get in. If you haven't watched my New Era Fortunes small cap webinar, please click the link in your email. I know many of you have watched it and signed up. I'm really excited about that. And we are closing subscriptions with a bang this week because we'll be issuing a brand new pick. And this is a company that's not even public yet. It's going to be merging with a special purpose acquisition company. So this is a publicly traded shell company that's merging with a battery maker for the electric vehicle market. And you know the success that we've had with the electric vehicle market as well as battery companies. That's why I'm really excited about this company. It's a small cap, so it doesn't fit into our automatic fortunes portfolio. And memberships to our small cap fortunes is extremely limited, and we're closing it on Friday. So if you haven't checked it out, please do so now. Okay. Let's talk about what's happened in the last week and the things that we've learned about the market, and perhaps some of the things we've learned about ourselves. We had a US election, and for months I was saying that this election is one of those things you consider an unknown known, in that you know that it's going to happen because the election happens on the first Tuesday of November every 4 years in the United States, but we don't know what the outcome is going to be. So there was a considerable amount of uncertainty. Well, there was a probability that we would have a Biden win, and the polls were way over what the actual outcome was. But then, we didn't have the blue wave, and now we have somewhat of a contested election, whether you believe it or not. But here's what I'm going to tell you. You need to focus on what's happening in the market. Forget about all the political stuff, because I've seen this play out before where people just take advantage of the fears that some people might have. And it happened in 2008. Back then, we had, Obama won. We were in the middle of a financial crisis. We have something similar going on right now with coronavirus. And there was a lot of hyperbole about how bad things were going to be in the future. The U.S. is a very resilient country. And when things look bad, or when people's perception of things are at the worst they possibly could be, that is an opportunity to get into the market. Case in point, what happened this year in March. In March, the coronavirus was spreading across the country. We didn't know what the long-term impact was going to be. We didn't know how many people were going to die. We didn't know what the therapeutics were going to look like or whether we'd have a vaccine. But now, you see the cases rising every day. And of course, we still need to social distance and wear masks when we can't social distance. But it's like the market doesn't care anymore. It's already digested that information. And we're starting to see that right now with the US election. The market, it didn't matter who won. If the headline said Trump wins, market soars, or Biden wins, market soars, the market was going to go up either way because institutions and hedge funds have been preparing for this event for months now. And I showed you that the amount of hedging they've done, if you look at the volatility indexes or how many puts they've been purchasing, they've been ready for this. So this is kind of one of those sell the rumor, buy the news events where now the market is set to rally into year end. And here's the reason why this market is going to go further than rallies in the past, and valuations are going to get way more stretched. The key reason why is that there was a huge shift in what the Fed did and said in the last year. And this is the new Fed under Jerome Powell. He's been in since 2017, but their posturing has totally changed. Now, let me explain something. Going way back in the Fed, their mandate or their rule of thumb was always that if unemployment was heading towards zero, and let's say it dropped to a certain point where there wasn't much slack in the labor market, they would start raising rates because they were worried about wage inflation. Okay. And this was what they called taking away the punch bowl that one of the Fed chairmen back in the 70s had noted. And between Volcker and Greenspan and Bernanke and Yellen, they all believed in this idea that you have to take the punch bowl away as soon as things start getting good, right? And if you've ever been a host of a party, that's the best way to shut a party down is you just take away the alcohol. And Jerome Powell has basically said it doesn't matter what happens in unemployment. We are not taking the punch bowl away. So we will be there with low rates and with quantitative easing, and we're going to let things run hot, okay? we're going to let investors get drunk. And they basically told you this. And if they're telling us this, we should listen to them. The one thing that would really concern me, though, is if we start to see interest rates skyrocket. I'll show you in a minute. The 10-year note, which is the key indicator of interest rates, is currently now at 96 basis points. So it's still below 1%. And globally, there's $18 trillion worth of bonds with negative interest rates. So the fact that rates are low, it pushes investors out towards riskier assets. Okay. And when rates are low, you can assume that growth levels are low. And when growth is low, investors are looking to buy companies. And when I say investors, I'm saying these huge, pension allocators and hedge funds, the ones that have trillions of dollars to invest. When growth rates are low, they're buying growth stocks. Our portfolio has been primarily focused on growth stocks. We look for companies that are growing earnings at 20% or more. And a lot of our companies don't even have earnings yet. So we're just looking at revenues growing 20% or more. And if they've got earnings, that's great. But usually we just need to see that earnings are coming in the next 3 or 4 years and they're earning a big share of what total addressable market they're looking at. So rates are going to stay low for now. If they start getting up to 2 to 3%, we will kind of rethink our strategy right here. But I still think growth is the place to go. And on top of that, you could also look at the small cap. So take a look at my screen right now so I can show you exactly what I'm talking about. So this is the TNX, and it is the SIBO 10-year Treasury note yield. It's an ETF that tracks basically what the 10-year bond does. 10-year bond is the most important bond in circulation because it's what every other corporate bond and mortgage bond and junk bond is priced off of. They all price off a spread to the 10-year Treasury note. Right now, as you can see, it's yielding 96 basis points. And this is the high it's been since March. And you would expect growth to come back a little bit because the coronavirus, it looks like we have a vaccine around the corner. And also, we've got a potential for a stimulus bill. So you would expect growth to start coming back a little bit, and we'll have bonds and 10-year interest rates over 1% soon. The low of this happened in March, and this was right when the stock market bottomed, and this was at 42 basis point or 0.42%. We had another little dip here in August to 0.51%. And keep in mind this number right here, because when I'm going to address a reader mailbag question that talks about bonds versus stocks. Now, when rates are low, it's good for growth stocks. And you can see that in the QQQs. And this is the index that tracks the NASDAQ. So it's mostly tech and biotech stocks. And when interest rates went down in March, we saw a huge rally in the Qs, and it outperformed the S&P. So the SPY, if you take a look at the SPY, it's sitting close to 52-week highs, but it did not bounce as strongly as the Qs did. Now, the small cap index has outperformed both of them in the last week, and investors are getting really excited about small cap because they're going to benefit the most when the economy reopens. Technically, small cap stocks carry the least amount of cash on their balance sheets. So when you hit an economic slump that could be caused from a prolonged wave of coronavirus, it's bad for small cap stocks because they have to go and issue more stock or raise more capital to keep their businesses going. And they're the first ones that declare bankruptcy when an economic slump hits. So that's why I'm bullish on small cap stocks right now, as seen here in the iShares Russell 2000 ETF, ticker symbol IWM. Now, I'm not recommending you buy this. I'm just pointing this out because it shows that small caps in the last couple of weeks have significantly outperformed their big cap brethren. Now, I want to talk just about a couple stocks right now before I dive into the mailbag. So Verra Mobility is a position we've had for about a year and a half, and they are a really interesting company. They make red light cameras. So when people blow through red lights, they get tickets, and they also make cameras on the arm of school buses. So when that school bus puts that stop sign out, you better not go around it because Verra Mobility's camera is going to snap a photo of your license plate and send you a ticket in the mail. They also are involved in E-ZPass. They have an app that lets you basically drive through any E-ZPass system around the country, and it pays the toll. So they do toll road navigation. They've got a big business in Europe, in the rental car industry where they use this Verra Mobility's product, and European travelers haven't really been there. So the rental car industry is kind of dead in Europe. I was really surprised that earnings were better than expected. The stock traded all the way up to 13. Keep this one on your radar, because if we hear talk of an infrastructure bill coming out in the next couple of months under a new Biden presidency, this is one of those companies that's really going to benefit. I know it dipped to a low as around $6 a share. And I said, I think we should hold this stock because eventually things are going to get better, not to sell it there. And now it's bounced back up to 13. So we'll see if it can break above its June highs. Lastly, I want to just mention Zillow Group. Zillow Group beat earnings expectations again, and Wall Street's just going crazy over this stock. We've been in Zillow since about 40. It traded a high almost about 120 a couple days ago after earnings, and it's still bouncing around a little bit, but I think this stock is going higher. It's just one of these stocks you want to keep in your portfolio, because as we transition to this new economy where everything goes digital, Zillow is going to dominate the real estate market. And if the housing market picks up as well, Zillow is a major player there. They do this thing called iBuying, where they just purchase homes. So if you want to get out of your house in 24 hours and move to another country, you contact Zillow, they give you a bid, and they close the deal, within 30 days, and you are out. You don't have to do any renovations or anything like that. And so I'm very bullish on Zillow, and I think this stock is going higher. So let me take a look in the mailbag right now. And I've got a question here from Ian. He says, "Hey, Ian, I want to start by saying thank you. Since I started following your advice, I've seen my portfolio double. I only wish I invested and stuck with all of your recommendations, but I have learned now. I have a couple questions. First, you have mentioned in past podcasts that all the big hedge fund managers and institutional investors have protected their assets from the high volatility we are currently enduring. I consider Bitcoin, Ethereum, and gold holdings as my only kind of hedge. Should I be reducing my downside risk with protection puts as insurance? Thanks again for all that you do." Okay, so Ian, thank you for the question. You also asked about options. So let's unpack this a little bit. Okay, so the first thing we want to talk about is how you should hedge your portfolio. And you mentioned Bitcoin and Ethereum and gold, and those aren't really hedges in the sense of what is a hedge. Bitcoin, Ethereum, and gold are what's known as uncorrelated assets. And like what I said earlier, remember in March when the yield on the bond went down to 48 basis points, the stock market was also down. Now, bonds were up because the price moves inversely to yield, which means that when bond yields are down, the prices are up. So the true hedge that you can put in a portfolio if you're worried about growth slowing is US Treasury bonds. Don't buy Bitcoin, Ethereum, or even gold as a hedge. They are not hedges. They are uncorrelated assets, which means that their price moves independently of the stock market. Okay. And I would say another thing, I think Bitcoin and Ethereum are actually more correlated to the stock market because they're very speculative assets. People buying Bitcoin are speculating that its price is going to go up because there's a lot of money printing going on around the world. And people buying Ethereum are buying it for two narratives. One, because the price of Bitcoin has gone up. And two, because Ethereum, like I mentioned in last month's newsletter, represents this Web 3.0 and will create the base layer for the new version of the internet where we are allowed to hold on to our data and not give it up to all the tech monopolies that seem to want to take advantage of our data and monetize it. So don't think of Ethereum as an uncorrelated asset. If the tech stocks sell off, Bitcoin and Ethereum are going to sell off with it. And for me, it's a matter of who owns the stuff. The people who own Bitcoin and Ethereum also own Apple and Microsoft, and they're very tech forward or tech thinking people. And that's why I think it'll be correlated more with tech stocks than as a hedge. So be careful. Now, when it comes to options are very risky. If you're just going to trade options as leverage, the question that I answered that I got a couple of months ago was basically, should we just be buying options on your stocks? If you don't understand options and how they work or the Greeks and how option pricing models work, just be very, very careful. We have services at Banyan Hill, and I'm also working on an option service that I'm going to share with you in a couple months. But just be very, very careful if you're using option. If you're going to do anything, just buy some LEAP puts. So you want to buy a put that's dated 2 years from now, put a small bit of it in your portfolio. If we have another crash like we had in March, you'll have a nice little earnings to offset your portfolio. I wouldn't call it a hedge because you have to know the exact amount of options that you need to buy to hedge your portfolio. And it's a little too deep of a discussion to get into now, but thank you for your question, Ian. Next question comes from James, and he says, hey, Ian, after your recommendation to purchase Ethereum, I looked into your suggested ways to accomplish that purchase. While checking on something else, I noticed I could buy Ethereum through PayPal with little to no premium costs. Is this viable in your eyes? This seems to accomplish the purchase of ETH without adding another purchase method for me. James, that is a great question and correct. In some states, PayPal is now letting users to purchase and hold Bitcoin and Ethereum. The other option that you have is if you have a Robinhood account or Robinhood app, or I think the easiest way is opening up a Coinbase account. You can just go on the internet to coinbase.com. It's very simple. You can set it up just like you're setting up a TD Ameritrade or a Schwab account. And Coinbase, from my experience, has the highest level of security. They've got this thing called a vault. So if you're going to buy a lot of these cryptocurrencies, it allows you to set it so that somebody can't come in and just send your Bitcoin or Ethereum out the same day. The transaction has to have multiple levels of approval, and there is a time delay before anyone can move your cryptocurrencies out of a Coinbase vault. But if you can buy it on PayPal, I think you should go ahead and do it. I mean, if there's no fees, the time is right. And speaking of Ethereum, the recent price was about 350. So we're looking at about a 20 or 30% gain here just in the last couple of weeks. And I think that Ethereum is going to continue to go higher because of what I outlined in my report about decentralized finance and also Web 3.0. You want to get into these investments now before everyone realizes the way the world is kind of going here. So we were able to do that in the solar stocks and Tesla, and I think Ethereum is going to be the next big winner for our portfolio. So thank you for that question, James. And that's it for this week's webinar. I want to thank everyone for tuning in. Remember, if you haven't checked out the New Era Fortunes webinar, where I outline my case for small cap stocks and the kind of stocks that I look for in small cap, check it out. Link in this lift letter in the email. And any questions, please reach out to us, automaticfortunes@banyanhill.com. Have a great week, everyone.